There are moments in markets when almost everyone feels calm, when headlines look ordinary, when prices appear to be simply moving up and down the way they always have. And then there are moments like this one, where beneath that surface calm, something far more significant is taking shape. If you are watching this right now, understand that the financial decisions you make in the coming months regarding silver could quietly determine whether you preserve purchasing power and build strategic exposure, or whether you end up reacting after institutional capital has already positioned itself. This is not hype. It is not a dramatic prediction. It is not built on anonymous rumors or social media excitement. Every figure, every reference, every structural observation discussed here is grounded in publicly available data and institutional level research. What is happening in silver is not random volatility. It is a structural development that major financial institutions have been studying and preparing for long before the broader public began paying attention. Only a few weeks ago, silver surged past $121 before sharply retracing to around $72. As this analysis is being presented, the metal is trading near 83s. To someone glancing quickly at a price chart, that movement might look like speculative chaos. But this was not a Reddit-driven short squeeze or a momentum-fueled retail stampede. The repricing reflects deeper forces that have been building for years. One of the most telling confirmations comes from JP Morgan, one of the largest and most influential banks in the world. In its recent precious metals commentary, the bank framed silver's behavior around the $80 level not as a temporary spike, but as something far more meaningful. Their analysis suggests that what we are witnessing is not random consolidation, but the formation of a structural floor supported by long-term fundamentals. That distinction matters enormously. When a global institution like JP Morgan publishes research on a commodity, it is not casual opinion. It reflects how billions of dollars in managed capital are being allocated. Hedge funds, pension funds, sovereign wealth funds, and major asset managers use this research to guide real money decisions. These are not speculative tweets. They are data-driven assessments that influence capital flows across global markets. The fact that silver remains structurally supported in their outlook, even with clear acknowledgement of risks, signals that institutional capital views current price levels as fundamentally justified rather than excessive. To appreciate why this matters, we need to step back and understand how silver reached this point. Throughout 2025, the metal staged a powerful rally that caught many market participants off guard. The advance was driven by a combination of accelerating industrial demand and persistent monetary uncertainty. By the final quarter of 2025, silver had already exceeded price targets that analysts had labeled ambitious just 12 months earlier. That momentum carried directly into 2026, with prices pushing toward and stabilizing near $80 per ounce, a level that carries both psychological gravity and technical importance. Psychologically, round numbers act as magnets in financial markets. The $80 mark attracts attention from traders, institutions, and long-term investors alike. Buyers interpret stability above such a level as confirmation of strength. Sellers often see it as a place to take profits. Technically, the zone around $80 represents a convergence of moving averages, Fibonacci extension levels, and high-volume trading clusters that institutional desks monitor carefully. What stands out is that despite repeated waves of selling pressure, silver has continued to hold above this region. That resilience suggests something critical. The capital stepping in at these prices is not speculative and fleeting. It is strategic and research-driven. JP Morgan's precious metals team specifically highlighted silver's ability to absorb selling without collapsing. In commodity markets, sustainability depends heavily on who is buying. When institutional capital dominates at a given price level, that level tends to persist because those buyers possess deep balance sheets and long-time horizons. Retail-driven surges can produce dramatic spikes, but they often unwind quickly when sentiment shifts. What we are seeing in silver resembles steady accumulation rather than emotional speculation. And that difference has enormous implications for what comes next. Another central component of the institutional analysis involves silver's unique dual demand structure. Unlike gold, which derives the majority of its value from monetary and investment demand, silver occupies a hybrid position. Roughly half of global silver demand in recent years has come from industrial uses, with the remainder divided between investment, jewelry, and silverware. This dual identity makes silver both powerful and complex. It responds simultaneously to monetary conditions and to industrial expansion. On the investment side, silver benefits from the same macro drivers that support gold. Inflation concerns, fears of currency debasement, geopolitical instability, and the desire for portfolio diversification all create demand for tangible assets. On the industrial side, silver is embedded in some of the fastest growing sectors of the global economy. Solar energy is perhaps the most significant example. Global solar installations have been expanding at compound annual growth rates that consistently exceed earlier forecasts. Government subsidies, declining panel costs, and aggressive decarbonization targets have fueled this expansion. China alone installed more than 200 gigawatts of new solar capacity in 2024, and that pace remained strong throughout 2025. The United States, Europe, India, and other regions have also expanded their solar deployment programs. When multiplied by the silver required per photovoltaic panel, this growth translates into tens of millions of additional ounces of annual demand. This is not a cyclical burst tied to temporary stimulus. It represents a structural transformation in how electricity is generated globally. Silver's unmatched electrical conductivity makes it difficult to replace in photovoltaic technology. Electric vehicles provide another expanding demand channel. Depending on design and model, a single electric vehicle contains between 25 and 50 grams of silver used in electrical systems and battery connections. As global EV adoption accelerates, cumulative silver consumption from this sector has become materially significant. Fifth-generation wireless infrastructure, commonly referred to as 5G, introduces yet another steady demand vector. Base stations, antennas, and semiconductors rely on silver for conductivity and heat management. The global rollout that intensified during 2024 and 2025 created a baseline of industrial consumption that did not exist a decade ago. Beyond these headline sectors, silver is used in medical instruments, water purification systems, brazing alloys, and countless electronic components that collectively add millions of ounces in demand each year. When these industrial drivers are combined with sustained investment demand, the result is a market where consumption has been growing faster than supply expansion. That imbalance forms the foundation of the structural thesis, and understanding that structural imbalance is essential before we move deeper into the supply dynamics and deficit conditions that institutions are now openly acknowledging. If demand is the engine pushing silver higher, then supply is the constraint that determines how far and how fast that engine can run. And this is where the story becomes far more serious than most casual observers realize. The global silver market has not merely experienced occasional tightness, it has been operating in a structural deficit for multiple consecutive years. That means annual demand has consistently exceeded the combined output of mining production and recycling. According to data published by the Silver Institute, widely regarded as the industry's primary research authority, the silver market recorded a deficit of approximately 182 million ounces in 2024 alone. That shortfall followed significant deficits in both 2023 and 2022. When deficits stack year after year, they create a cumulative drawdown effect. Inventories that once seemed comfortable begin to shrink. Stockpiles that were considered buffers gradually thin. And the market transitions from balance into dependence on above-ground reserves. To put that into perspective, global mine production has hovered in the range of roughly 800 to 850 million ounces per year. Recycling contributes an additional 150 million ounces annually. Yet total global demand has surpassed 1 billion ounces in recent years. When consumption exceeds new supply by such margins, the difference must come from existing inventories. That metal is pulled from exchange warehouses, London vaults, ETF holdings, and privately held refined stocks. And those inventories are not infinite. Registered silver stocks on commodity exchanges have declined meaningfully from their historical peaks. At one point, exchange inventories exceeded approximately 400 million ounces. Since then, substantial withdrawals have reduced that figure significantly. London Bullion Market Association vault holdings have also trended lower as silver flows eastward to meet industrial demand. Persistent inventory drawdowns are not just accounting details, they are signals. They indicate that supply is not replenishing at the pace required to match demand. One of the most misunderstood aspects of silver is how it is produced. Unlike gold, which is primarily mined for its own value, silver is overwhelmingly a byproduct metal. Roughly 70 to 75% of global silver production comes as a secondary output from mining copper, zinc, lead, and gold. That dynamic creates structural rigidity. When copper prices are strong, copper miners expand output, and silver production rises incidentally. But if base metal prices weaken and companies cut production, silver output declines even if silver prices themselves are high. This means silver supply does not respond directly or proportionally to silver price increases. A rise to $80 per ounce does not instantly trigger a wave of new silver mining capacity. Primary silver mines do exist in countries such as Mexico, Peru, and Poland, but they represent a smaller fraction of total output. Developing new mines requires exploration, feasibility studies, environmental permitting, financing, construction, and commissioning. The timeline from discovery to production often spans 7 to 12 years. Even if today's prices justify new projects economically, the physical metal will not reach markets quickly. This supply inertia is one of the core pillars of institutional confidence in silver's structural positioning. However, no serious analysis would ignore the concept of substitution risk. At lower prices, Silver constituted a relatively minor input cost in solar panels and electronic devices. When silver traded between $25 and $30 per ounce, manufacturers had little urgency to reduce silver usage. But at $80, the economics change. The cost contribution per unit rises meaningfully, prompting increased investment in thrifting and alternative materials. In solar manufacturing, companies are actively researching methods to reduce silver paste usage and experimenting with copper-based metallization technologies. These alternatives are promising but present efficiency trade-offs and scaling challenges. In electronics, copper and palladium can replace silver in certain applications, yet conductivity and durability limitations remain. The key insight emphasized in institutional research is that substitution is a gradual engineering process. It requires validation, capital investment, and production adjustments. Even if higher prices accelerate innovation, the impact unfolds over years rather than months. That distinction is critical. Substitution moderates demand growth over time, but it does not collapse consumption abruptly. It acts as a pressure valve, not an on-off switch. And while this moderating force deserves attention, it does not erase the existing structural deficit. The macroeconomic environment further shapes silver's trajectory. Precious metals respond heavily to real interest rates. When inflation exceeds nominal interest rates, real yields turn negative, eroding the purchasing power of cash and bonds. In such environments, tangible assets like silver and gold often attract capital. Throughout 2025, the Federal Reserve navigated a complex balancing act between managing inflation and supporting economic growth. Policy decisions influenced bond yields, currency strength, and investor allocation behavior. Real yields have fluctuated within a range that remains supportive for precious metals without delivering extreme tailwinds. The US dollar index has also experienced alternating phases of strength and weakness, influenced by global growth differentials and monetary policy divergence. Because silver is priced globally in dollars, a stronger dollar can dampen international demand by raising effective local currency costs. Trade policy adds another layer of complexity. Tariffs on imported goods, including solar panels or electronic components, can alter domestic industrial economics. Higher installation costs may slow deployment in one region while leaving global expansion intact. Geopolitical tensions create background uncertainty that supports safe haven allocation into tangible assets. Investors increasingly recognize that physical commodities cannot be digitally frozen, sanctioned, or defaulted upon. Silver's smaller market size relative to gold amplifies price sensitivity. Even modest changes in investment demand can produce substantial percentage moves. Exchange-traded funds backed by physical silver play a central role in this mechanism. When inflows rise, ETFs purchase physical bars, removing supply from circulation. When outflows occur, metal returns to the market. Throughout 2025 and into 2026, ETF flow patterns have generally aligned with silver's advance toward the $80 region. Meanwhile, silver continues to flow geographically toward Asia. China dominates global photovoltaic manufacturing, producing an estimated 80% or more of the world's solar cells. Provinces such as Guangdong and Jiangsu consume massive quantities of silver embedded in panel production. India has also emerged as a significant demand center, driven by both industrial use and long-standing cultural affinity for silver jewelry and religious items. This diversified demand base is structurally important. Silver pricing is not dependent solely on U.S. economic performance. Even if domestic industrial growth slows, expanding Asian manufacturing and global investment flows provide counterbalance. That geographic diversification reinforces institutional confidence that silver's current price levels are supported by real structural forces rather than temporary enthusiasm. To determine whether silver at $80 represents excess or opportunity, history provides essential perspective. Silver's nominal all-time high occurred in April 1980, when prices reached approximately $49.82 per ounce during the Hunt brothers' attempt to corner the market. Adjusted for inflation using the Consumer Price Index, that peak would translate to roughly $170 to $180 per ounce in today's dollars. That comparison changes the narrative immediately. Even at $80, silver trades at less than half of its inflation-adjusted historical high. From a long-term standpoint, the metal is not in unprecedented territory. Another important metric institutional analysts evaluate is the gold-to-silver ratio, which measures how many ounces of silver are required to purchase 1 ounce of gold. Over extended historical periods, this ratio has tended to fluctuate within a broad range, often between 40 and 60, though it has widened or narrowed significantly during times of financial stress or speculative excess. With gold trading at elevated levels and silver positioned near $80, the current ratio suggests that silver has not yet fully matched gold's appreciation. Many analysts argue that during sustained precious metals bull cycles, silver often outperforms gold in later stages due to its smaller market size and industrial demand leverage. Central bank activity reinforces the broader precious metals narrative. While central banks primarily accumulate gold rather than silver, record gold purchases in recent years have reshaped global monetary dynamics. Countries such as China, India, Poland, and Turkey have expanded gold reserves aggressively as part of diversification strategies away from the US dollar. Although central banks do not typically buy silver, their behavior strengthens confidence in tangible monetary assets. That confidence often spills over into private silver investment, particularly among investors seeking a lower price entry point within the precious metals complex. The mining industry's trajectory further underscores supply constraints. Major producing nations like Mexico and Peru face regulatory shifts, environmental scrutiny, and community resistance that complicate new project approvals. Mexico, the world's largest silver producer, has experienced periods of policy uncertainty that discourage fresh capital investment. Peru has dealt with social unrest affecting mining operations. In the United States, production remains concentrated in states such as Nevada, Idaho, and Alaska. Operations including the Rochester Mine in Nevada and the Greens Creek Mine in Alaska contribute meaningfully, yet U.S. output accounts for a relatively small share of global supply. Exploration projects continue worldwide, but the pathway from discovery to commercial production remains lengthy and capital-intensive. Recycling provides an additional 150 to 200 million ounces annually, yet expansion of recycled supply faces economic and logistical limitations. Photographic recycling, once significant, has diminished as digital imaging replaced film. Electronic waste recycling is growing, but remains constrained because individual devices contain small quantities of silver, making collection and processing less economically attractive. Taken together, these realities form a supply structure that cannot rapidly expand in response to rising prices. That rigidity supports the institutional thesis of sustained deficits. For American investors evaluating silver's role within a broader portfolio, the first principle is disciplined allocation. Silver should function as a component of diversification rather than a singular concentrated wager. Many financial advisors suggest allocating between 5 and 15% of a portfolio to precious metals, depending on individual objectives and risk tolerance. Within that allocation, the balance between gold and silver reflects personal preference. Silver offers greater volatility and potential upside, while gold provides relative stability and deeper liquidity. Exposure can be achieved in several ways. Physical silver in the form of coins and bars eliminates counterparty risk. American Silver Eagle coins, minted by the United States Mint and guaranteed at 99.9% purity, remain popular among investors. However, physical ownership involves premiums over spot price and requires secure storage. Exchange-traded funds backed by physical metal provide liquidity and convenience without storage logistics, though they carry management fees and do not fully eliminate counterparty considerations. Mining equities offer leveraged exposure. When silver prices rise, efficient producers can experience profit expansion exceeding the metal's percentage gains. Conversely, downturns compress margins and amplify losses. Futures and options provide tactical flexibility but introduce leverage, margin requirements, and complexity that may exceed the comfort level of many investors. Tax considerations are also significant. The Internal Revenue Service classifies precious metals as collectibles, subject to a maximum long-term capital gains rate of 28%, higher than the 15 or 20% applied to most stocks. Holding silver within a self-directed individual retirement account can offer advantages, though regulatory requirements must be followed carefully. Within the broader commodity landscape, silver's positioning stands out. Copper shares electrification demand drivers, but is appreciated less dramatically in percentage terms. Platinum and palladium face pressure from the global transition toward electric vehicles that do not require catalytic converters. Gold continues to benefit from central bank buying and geopolitical uncertainty. Historically, silver has tended to outperform gold during mature bull cycles due to its smaller market capitalization and industrial leverage. For investors already holding gold, adding silver may enhance diversification within the precious metals segment. Attempting to time exact market tops or bottoms is extremely challenging. Even institutional traders with sophisticated models struggle with precision timing. Dollar-cost averaging offers a structured approach. By investing consistent amounts at regular intervals, investors can accumulate exposure while smoothing volatility. Emotional discipline during price pullbacks is often the greatest challenge, yet those pullbacks frequently provide long-term opportunity. Institutional analysis emphasizes that as long as structural deficits persist, industrial demand expands, and macroeconomic conditions remain supportive of real assets, the fundamental case remains intact. Risks exist. A dramatic increase in supply, a technological breakthrough significantly reducing silver usage, or a sustained period of high real interest rates could alter the outlook. However, based on current evidence, none of these scenarios appears imminent. Substitution risk remains the primary moderating force, but its influence develops gradually. Investors therefore have time to monitor developments and adjust allocations thoughtfully rather than react impulsively. Understanding these structural dynamics transforms volatility from a source of fear into a manageable feature of the asset class. The silver story is still unfolding. Institutional recognition of $80 as a meaningful level, persistent multi-year deficits, expanding industrial adoption across solar energy, electric vehicles, telecommunications infrastructure, and electronics all contribute to a compelling structural chapter. Whether participation occurs through physical ownership, exchange-traded vehicles, mining equities, or informed observation, knowledge creates advantage. Markets consistently reward preparation over reaction, and investors who understand structural forces, rather than chasing noise, position themselves far more effectively for whatever the next phase of this cycle brings.